Every bubble has its architects. Every crash has its quiet winners. And every generation, without fail, tells itself that this time is different. Yet history whispers the same story over and over. And some investors, some institutions, know it, so well they profit while the world burns. The year was 1929. The Roaring Twenties, a decade of dizzying growth and endless optimism. The stock market soared. Factories hummed. Automobiles flooded the streets. People bought shares on margin, borrowing money they didn't have, betting on a future that seemed unstoppable. And somewhere high above the chaos of ticker tape and clinking champagne glasses, a small network of financiers watched the frenzy and smiled. They weren't ordinary investors. They were connected, informed, and ruthless. For them, the stock market wasn't a gamble, it was a machine. A machine designed to redistribute wealth upward. And in 1929, the machine had reached peak speed. Here's the pattern. It always starts with exuberance. Prices climb faster than earnings. Sentiment, not fundamentals, drives the market. Then comes leverage, borrowed money, inflating the bets. And somewhere within the crowd, a few hands hold the keys. They know where the exits are, and they wait. Leading the pack in 1929 were names that history remembers vaguely. People like Richard Whitney, the head of the New York Stock Exchange, and the banks that quietly financed massive positions. They weren't printing money in the literal sense, but they were manipulating flows of capital in a way that ensured they could profit regardless of the outcome. Whitney, for instance, acted as a central figure in propping up stocks, buying shares at critical moments to create the illusion of stability, until it was time to sell. The market peaked in September. Prices were absurd. Companies were valued at multiples no sane metric could justify. Yet the public, caught in the frenzy, continued to buy. Margin debt reached record highs. People were borrowing money to buy stocks at levels they couldn't begin to repay. And the insiders, the handful of institutions that mattered, were quietly trimming their positions, selling into the buying frenzy, collecting fortunes as prices soared. Then came Black Tuesday, October 29th, 1929. The market collapsed. Panic spread. Margin calls hit. Banks failed. Factories closed. Millions lost their savings, their homes, their livelihoods. The economy went from boom to depression almost overnight. And yet, some investors walked away unscathed. Some didn't just survive. They had already sold their positions before the panic fully hit. They didn't gamble with margin. They controlled it. They weren't caught in the crowd's hysteria. They orchestrated it. Take, for example, the case of J.P. Morgan's inner circle. Though the public perceived the crash as sudden and chaotic, Morgan's network had been preparing months in advance. They knew which stocks were overleveraged, which sectors would falter first, and how to coordinate block trades without triggering suspicion. When the market fell, their losses were minimal. Meanwhile, smaller brokers, speculators, and everyday investors absorbed the full force. The pattern, in retrospect, is unerringly precise. Identify speculative excess, leverage public greed, and sell before the collapse. Then, after the dust settles, buy again at depressed prices. It's not luck, it's strategy. A few billionaires in 1929 became exponentially wealthier, while millions suffered. And the system allowed it to happen without legal repercussions. Regulations were weak, disclosure laws almost non-existent, and the moral hazard was built into the market's DNA. And yet, history repeats. The seeds of the next crash were planted almost immediately after 1929. The lessons weren't for everyone, just for those watching, those who understood that volatility isn't risk, it's opportunity. By 1932, while unemployment peaked at 25%, these investors were quietly acquiring assets at rock-bottom prices. Real estate, distressed stocks, banks, anything that had value. They turned a catastrophe into a wealth creation engine, simply by understanding a pattern that the rest of the world refused to see. What made it even more remarkable is that this wasn't hidden. The same banks and financiers who had caused panic were simultaneously propping up their positions and preparing for recovery. They had access to information no one else did, connections across sectors, and capital to buy when others were desperate. They profited from the crash twice, first by selling at the peak, then by buying at the bottom. This is the crash profit pattern. It's not a conspiracy theory, it's documented history. Every major crash in the 20th and 21st centuries follows a similar sequence. And every time, a small number of insiders extract fortunes while the majority pays the cost. And here's the crucial insight. The market isn't chaotic. It only appears so. Crashes aren't accidents. They are structural, predictable, and exploitable. And the individuals who understand the structure, who can navigate leverage, sentiment, and timing, don't just survive the collapse, they profit from it. By the end of 1929, the Great Depression was underway. Millions suffered. But the pattern had been executed perfectly. The crash profit pattern wasn't just born in 1929. It was validated. The system had its proof of concept. And while the public endured decades of hardship, a few carefully positioned investors and institutions accumulated wealth that would rival the pre-crash era and set themselves up for the next iteration. Fast forward 79 years. The world looked different. Skyscrapers replaced factories, derivatives replaced ticker tape, and computers executed trades faster than a human eye could follow. But one thing hadn't changed. Human greed, amplified by leverage and opacity, was still the engine of crisis. The 2008 financial collapse didn't erupt overnight. It was years in the making. Housing prices had been rising steadily for a decade. Mortgage lenders were loosening standards. Banks packaged subprime loans into complex securities, collateralized debt obligations, mortgage-backed securities, and sold them to investors around the globe. The public believed in endless growth. Credit flowed freely. The bubble expanded. And somewhere high above the chaos, the same pattern of patient insiders was forming. Who were the architects this time? Not a single person, but networks of investment banks, hedge funds, and a few extraordinarily well-connected investors. Names like Goldman Sachs, Lehman Brothers, before its collapse, Bear Stearns, and the quietly omnipresent hedge funds that acted as market accelerators. And just like 1929, the pattern was clear. Identify speculative excess, leverage it, then extract wealth before the collapse. By 2007, cracks were showing. Home prices in Florida, California, and Arizona were stalling. Defaults in subprime mortgages began rising. Yet the public, homeowners, and investors alike still believed housing was invincible. Financial institutions continued to push risky loans, securitize them, and sell them to pension funds, insurance companies, and foreign banks. It was a global machine of debt, risk spread far and wide, yet controlled by a few who understood the leverage points. Then came September 2008. Lehman Brothers collapsed. Panic swept through the financial system. Credit froze. Banks refused to lend to each other. Stock markets plunged. But the insiders had already prepared. Hedge funds that had shorted the housing market, betting that mortgage-backed securities would fail, collected billions. Goldman Sachs had shifted risk off its balance sheet, quietly hedging positions in the months leading up to the collapse. Certain hedge fund managers, like John Paulson, famously made tens of billions by predicting the fall in subprime mortgages. The mechanics were almost identical to 1929. Leverage fueled the rise. Public optimism inflated asset prices. And when the collapse came, a small, informed cohort profited while millions suffered. People lost homes, pensions, and savings. Unemployment soared. Governments scrambled to bail out the banks with taxpayer money, a move that, in effect, transferred public wealth to the very institutions that orchestrated the risk. And just like 1929, the recovery created a second wave of profit. The Federal Reserve slashed interest rates and launched quantitative easing, injecting trillions into the financial system. Large banks, hedge funds, and asset managers acquired distressed assets at fire sale prices. Real estate, corporate bonds, even entire companies were bought for fractions of their pre-crisis value. In less than 5 years, the same investors who navigated the collapse were wealthier than ever. Here's the unnerving part. The crash profit pattern wasn't accidental in 2008 either. It was structural. Derivatives allowed risk to be distributed, but not eliminated. Complex financial instruments masked vulnerability from the public, while insiders understood exactly how exposure was concentrated. And regulatory gaps, much like the absence of safeguards in 1929, allowed certain investors to profit on both sides of the collapse. They bet against the market while simultaneously participating in the boom. Consider this. In 1929, insiders sold before the crash, then bought at the bottom. In 2008, the strategy evolved. Insiders bet both ways. Short positions profited from collapse, while distressed assets purchased at the trough ensured gains in the rebound. And governments, far from punishing this behavior, effectively guaranteed it. Bailouts ensured no institution was too big to fail, cementing the moral hazard and repeating the cycle of wealth extraction. The parallels to 1929 are striking. Margin debt in the 1920s is mirrored by leverage ratios in 2007 to 2008. Investor euphoria then is echoed by irrational exuberance in housing markets. Insider knowledge, coordination, and strategic positioning appear again. The mechanisms are more complex now. Derivatives, credit default swaps, global banking networks. But the underlying pattern is unchanged. And it's not just about wealth accumulation. Crises create opportunities to reshape markets. In 2008, the same hedge funds and banks that profited also positioned themselves to dominate emerging sectors. Private equity, distressed debt, and even government-backed institutions. Just as in 1929, a crisis destroyed competitors, eliminated risk-averse investors, and concentrated power in the hands of those who understood the pattern. By 2010, the recovery was underway. Housing markets stabilized. Stock indices climbed back to pre-crisis levels. Banks, hedge funds, and asset managers had rebuilt, stronger than before. The public, exhausted and poorer, rarely noticed who had benefited. And the blueprint was clear. Crashes are temporary. Profit patterns are permanent. Here's the chilling conclusion. The same investors or their institutional descendants understood the 1929 collapse, internalized the 2008 crisis, and are now positioned to exploit the next cycle. The world's financial system is still structured to allow it. Leverage, opacity, and systemic interconnectedness ensure that the pattern continues. The lesson from 2008 is simple. The public sees panic and collapse. Insiders see opportunity. And the cycle, euphoria, leverage, collapse, profit, repeats with a precision that borders on inevitability. The only variable is timing. By now, you begin to see it. The crash profit pattern isn't about chance. It's about systems, information, asymmetry, and timing. It's about a small network of actors understanding the flow of money and using crises to accumulate wealth while the majority bears the cost. And just like 1929, this knowledge is passed down, embedded into institutions, financial strategies, and market structures, so that when the next collapse arrives, the same pattern will unfold once again. The year is 2025. The markets are digital, global, and faster than any human mind can fully grasp. Algorithms trade billions of dollars in milliseconds. Hedge funds, asset managers, and private equity firms operate across continents, moving capital with surgical precision. But the crash profit pattern hasn't changed. The players have evolved, the instrument have changed, but the strategy remains eerily familiar. Start with the setup. Asset prices are inflated across multiple markets. Tech stocks trade at valuations that would have been absurd even 5 years ago. Real estate in major cities has outpaced wages by multiples. Government debt has reached historic highs. And global credit continues to expand. Mortgage debt, corporate debt, sovereign debt, all riding on the expectation that interest rates remain low and liquidity remains abundant. Every bubble follows the same trajectory. Optimism, leverage, mass participation, overvaluation, and then the quiet exit of the informed few. In 2025, the informed few are hedge funds, central bank insiders, private equity giants, and the elite network of asset managers who understand systemic vulnerabilities. Institutions like BlackRock, Vanguard, and State Street control trillions in assets, much of it other people's money. And the tools they have at their disposal are unprecedented. They can hedge, short, leverage, and manipulate exposure across multiple asset classes simultaneously. Look at it closely. Tech valuations reminiscent of the dot-com bubble. Bond markets that assume governments can endlessly service debt. Housing markets in major urban centers that mirror 2008 subprime dynamics. Margin accounts and derivatives proliferate. And yet, the public is largely oblivious, lulled into the belief that central banks will prevent any serious downturn. That belief, the faith in perpetual intervention, is exactly what ensures the next cycle. The mechanics of profit haven't changed. Identify overvalued sectors. Position strategically. Hedge against downside risk. When panic hits, the losses of the uninformed become the gains of the prepared. The playbook is textbook. Sell into euphoria, collect when leverage forces liquidations, and then buy back at distressed prices. Just as in 1929, just as in 2008, crises are converted into multi-billion-dollar opportunities. Take the Federal Reserve's extraordinary influence today. In 2008, quantitative easing stabilized markets and ensured asset prices rebounded. Today, central banks continue to act as implicit backstops, creating what insiders call the put, a guarantee that markets will be supported when panic arrives. That put encourages leverage, inflates valuations, and increases systemic risk. And insiders understand it. The public sees a safety net. The informed few see the opportunity to exploit it. Then there's private equity. When markets wobble, private equity firms swoop in to acquire distressed companies at discounted prices. Hedge funds profit from volatility. Institutional investors with global reach can absorb short-term losses to position themselves for long-term gain. The system is interconnected, global, and opaque, precisely what makes the crash profit pattern so effective. And this isn't theory. Look at recent warnings. Corporate debt is at all-time highs. Governments carry unsustainable fiscal obligations, and interest rates, though rising, are still artificially low in historical context. Housing bubbles exist in multiple countries. Tech valuations are sky-high, and cryptocurrencies and other speculative assets are experiencing massive inflows. These are the signals, the same signals that preceded 1929 and 2008. It's important to understand the asymmetry here. Most investors, retirees, pension funds, retail traders are exposed to these risks without realizing it. They feel the market is safe because indices are rising. They believe diversification and professional management protects them. But the reality is stark. The system is rigged to favor those who see the pattern. When panic hits, they will profit. And unlike the public, they can act before the collapse fully manifests. Who are the modern beneficiaries? The largest hedge funds, the biggest asset managers, and insiders with privileged information. The very same structures that profited in 1929 and 2008. They have more tools than ever. Algorithmic trading, real-time global data, and the ability to move capital instantaneously across borders. They don't just react to crises, they anticipate them. And they structure positions that profit from every potential outcome. And just as before, there's the second wave. After a crash, markets will be reset. Distressed assets will be acquired at fire sale prices. Companies will consolidate under fewer hands. Wealth will concentrate in a manner that ensures the pattern endures. Governments may step in to stabilize the system, but the intervention often benefits the same insiders who created the conditions for profit. History, in this sense, is not merely repeating, it's compounding. The message is clear. The crash profit pattern is now baked into the structure of modern finance. The lessons of 1929 and 2008 have not been learned by the masses. They've been mastered by the few. And the scale is larger than ever. Trillions of dollars, global exposure, and instantaneous information flows ensure that when the next crash arrives, the opportunities for profit will dwarf anything seen in history. Here's the unsettling truth. The timing of the next crash is irrelevant. The system guarantees it. Debt levels, leverage, asset bubbles, and global interconnectivity all point to inevitable disruption. And while the public will panic, insiders will execute the same strategy. Sell, hedge, profit, then buy back at depressed prices.